What's up, guys? Let's go over something super critically important: how to balance or evaluate a company. We'll just go right into it. Here is an example company. It is NetEase. They are an internet software and service company. Their stock price has done pretty well in the past few years. Um, it's a really good example of a company with a good balance sheet. Nothing crazy spectacular, but pretty good, something worth looking at and a good example to run off of. So first thing I like to look at, and I'm going to be talking about how to evaluate a growth company, right? Not like a Warren Buffett style value investment. I'll try to do that in one of my later videos. Um, so for a growth company, what I love to see is to go to the annual tab here and kind of just see an increase here. You want to see kind of more of a exponential growth rather than like linear, right? So 1300, 1600, 2000, 3500, 6000 nearly. That's the kind of growth you're looking for in a growth company. You want to see percentage increases that are increasing. So that right there is right off the bat, like great. You want to look for 20% increases at least, right? So from here to here, that's well over a 20% increase. So this is like an exceptional example right now for gross revenue. The why gross revenue matters is because it demonstrates that they're increasing their sales like greatly. Next thing that I really think matters a lot is coming down here to the income tab down here. So this is saying whether or not the business is profitable, right? So, if their revenue grows exponentially, but their income is not growing or staying steady, then, that's going to show up as problems, when they release earnings and stuff like that. And the company stock price probably will not exhibit, great forward movement. It could still be pretty good, but I'm showing you guys like what I look for is I look for the best. So generally, I want to see this go up an equal exponential factor as the revenue. So I don't want to see their costs going up a lot. Basically this tells me their costs are not increasing too much. I want to see at least again, I'd say like 15% between the last year from from 2015 to 2016. I want to see at least 15% increase in the income. Next thing that I really find important here on this is like a simplified balance sheet, right? Is the earnings. So earnings per share, very important, right? That's like, they release their earnings and everyone goes crazy if their earnings are great. Everyone goes crazy if their earnings are bad, so earnings are important, of course. So generally, you want to see the earnings are doing better and better. So here we go. We look at the earnings per share. I mean, you can look at, there's a lot of tabs, a little like sections here. They're all basically say very similar information. But here we can see, okay, it was kind of steady, and now you can see in the last, few years here, it's kind of jumping up. It's spiking, just like the net income and the gross revenue. So that's perfect. Those are the main things I look for. Of course, there are a lot of other things I keep track of, but I would say, for a simplified look into this, those are the main things I look at. And then the next main thing I check is the ratios here. Make sure that they have a pretty good return on equity. So 35%, that's 36%, that's really good. I like to look for at least around 15%. Above that is anything above 15% I find is decent, is pretty good, but 36% is really good. Yeah, so how I evaluate now the company's worth is basically on the basis of these earnings continuing to grow. So what I do is I look at the valuation of the company at like an average earning price, let's say around here, right? So I'll say the average price from here to here is like $250, and I'll take the average earnings per share, over like the last year here and see, has the market been valuing the company greater and greater as the earnings have increased? And, in this case, it has been. So as the earnings increase, it seems like the value of this company increases. So there's probably not like a crazy upward movement to come for this company, like it's being valued as the earnings increase, right? But another company, say like um, that has been sitting around while it's been growing its earnings, like for instance WD, for all this time, its average share price was like at $25 in between this massive correction time. But in all this time from here all the way to here, this stock was just dominating its earnings reports. It was evaluating itself higher and higher. So once it kind of got out of this terrible little correction bubble and came up to here, that was an extreme indication that the market is now going to start valuing the company at what it should be valued at. So because the market didn't react for all this time. So I take the average earnings per share and I see that they're increasing, and I see the average price is staying the same. So when I came up to when the stock was valued at like around 31.55 and came out of this rut here, I was eager to jump in, and I'm glad I jumped in. It's had a huge upward swing, and now as the company continues to increase its earnings per share, its value is increasing. So it's a safe bet still. Hopefully, you don't know what's a safe bet always in the stock market. But yeah, that's a short rundown of kind of like how my strategy works for evaluating a growth company. Um, yeah, there's a lot of strategy though that goes into picking and timing, right? And 50%, 8% losses, taking your losses and whatnot. But that's generally how I evaluate a company. Anyway, let's keep that short and end it there. If you like, subscribe, and you subscribe, like the video. Peace out. I'll see you guys next time.